If you're a physician earning $300,000 or more, here's an uncomfortable truth. You're likely overpaying the IRS by tens of thousands every year. Not because you did anything wrong, but because nobody taught you this in medical school. Today, we'll uncover 5 strategies that real physicians use to legally cut their tax bill by $50,000 or more. The last one is the most overlooked of all. Most attendings sit in the 32%, 35%, or 37% federal bracket. Then you add state tax and a Medicare surtax, and nearly half your paycheck disappears before it hits your account. And most physicians follow what I call the default plan. They max the 403(b), take the standard deduction, file in April, and hope for the best. The wealthy don't pay less because they cheat. They pay less because they plan. Let's get into it. Point 1. Stack your retirement accounts. Stack every retirement account you can access. Most physicians know about the 401k or 403(b). The 2026 limit is roughly $24,500, but that's just the start. If your hospital offers a 457(b), that's another $2,400 sheltered. Add a backdoor Roth IRA. Another $7,500 growing tax-free for life. Have 1099 income from moonlighting or consulting? A solo 401k lets you contribute up to roughly $70,000 depending on income. A physician earning $500,000 who stacks all of these can shelter over $100,000. At a 35% marginal rate, that's $35,000 in tax savings from only one strategy. Point 2. The HSA Triple Tax Advantage, the Health Savings Account. If you're on a high-deductible plan, you can contribute. The 2026 family limit is around $9,000. Here's why it matters. The HSA is the only account in the entire tax code with 3 layers of protection: tax-deductible going in, tax-free growth, and tax-free withdrawals for medical expenses. The trick most physicians miss? Don't spend it. Invest it. Pay medical bills out of pocket and save the receipts. Let the HSA compound for decades, then withdraw tax-free in retirement. Point 3. Real estate and depreciation. This is where physicians can really move the needle. Rental properties generate income. But thanks to depreciation, much of that income shows up on paper as a loss. The IRS lets you depreciate the structure over 27.5 years. On a $500,000 rental, that's roughly $15,000 a year in paper losses, even when the property cash flow is positive. For most physicians, those losses are passive. But here's the exception. If your spouse qualifies as a real estate professional, those losses can offset your W-2 income directly. A couple with a stay-at-home spouse managing a few rentals can legitimately wipe out $50,000 to $100,000 of taxable income per year. Point 4. Strategic charitable giving. Give smarter, not just more. 2 moves stand out. First, the donor-advised fund. Contribute a large lump sum in a high-income year. Take the full deduction now. Distribute to charities over many years. This move is powerful in bonus years or Roth conversion years. Second, donate appreciated stock instead of cash. You skip the capital gains tax and still deduct the full market value. 2 wins from 1 transaction. Point 5. The S-Corp election. The most overlooked one. If you have a meaningful 1099 income, locums, consulting, expert witness work, telemedicine, consider forming an S-corporation. As a sole proprietor, every dollar of profit gets hit with 15.3% self-employment tax. With an S-Corp, you pay yourself a reasonable salary. The remaining profit flows through as a distribution. Distributions are not subject to self-employment tax. On $100,000 of side income, that move alone can save $5,000 to $10,000. Plus, you may qualify for the qualified business income deduction, shaving another 20% off qualified profit. So here's your playbook. 1. Stack every retirement account. 2. Max and invest the HSA. 3. Explore real estate, especially with a qualifying spouse. 4. Give strategically with donor-advised funds and appreciated stock. 5. S-Corp your 1099 income. If this helped, hit like and subscribe. Until next time, take care of your patients and take care of your wealth. This content is for educational purposes only and does not constitute financial or tax advice. Always consult a qualified tax professional or CPA before making any tax-related decisions.